High yield dividend investing doesn't have to mean taking crazy risks. If you know how to screen properly, you can find high yield and high quality dividend stocks in minutes. My name is Zach, the founder of Dividend Data, a stock research platform specifically designed for dividend-focused investors. I'm going to show you the exact process I use to screen for high-yield dividend stocks. It's fast, simple, and helps you avoid potential yield traps. By the end of the video, I'll provide you with a few examples of quality high-yield dividend stocks, companies with high payouts, and reliable dividend growth. Plus, I'll give you my process so that you can do the research yourself. The first step is screening. You have to find the companies before you go into it and analyze them. And you can start this with something as simple as a natural language prompt. Say, stock screener, find US stocks with a dividend yield over 5% and 3-year dividend CAGR over 3%. What that last part means is you're looking for companies that are growing their dividend payments over the past 3 years at a compound annual growth rate of at least 3%. Because part of what makes a quality high yield dividend stock is that it's growing. You don't want a company that's going to cut their dividend right away. And now you have a list that's a great starting point to start looking for these kinds of companies. As you can see, it pre-filled your screening options. And another factor we might want to consider here is something like the payout ratio. In general, we don't want a company with a payout ratio over 100% because that can't be sustainable over the long term. But what I'm actually going to do here is put at 110% because sometimes there can be some edge cases as payout ratio is based on GAAP accounting. And some of these businesses, you want to look towards free cash flow or distributable cash flow. By the way, there are hundreds of potential options you could be screening from, whether it's growth rates of EBITDA, cash from operations, simple valuation ratios like price to earnings or price to operating cash flow. So we're going to add that payout ratio and hit regenerate. And we quickly have a list of high yield dividend stocks that are continually growing their payments in recent years. And this gives us a great starting point to start doing further research into these companies. And I'll give you my process of how I determine whether or not this is potentially a quality business to invest in. So as an example, we'll start with something like MO, the Altria Group. Search the stock up so we can do some deeper analysis. And for the purpose of this video, we're going to focus our analysis around the dividend and factors that would impact dividend growth over the long term, and also look for red flags around potential dividend cuts. Now, this is a company I've done a lot of research on in the past, so I'll fill you in with some background knowledge you might not have known. Here we can see the historic stock price and earnings per share chart. And if you're wondering why there's big drop-offs here, the Altria Group had spin-outs in those years of some pretty large businesses, both Philip Morris International and actually Kraft Foods. And the business that remained at that time was Philip Morris USA and the related United States assets. And since that point, there has been reliable earnings per share growth in the Altria Group. And in general, when we're looking at these companies, you want to see a trend of continued earnings growth because that's how you support future dividend growth. If the company's not growing, they can't continue to pay you growing dividends in the future. So let's dive into the dividend data. The forward-looking dividend payment for the Altria Group's $4.24. Based on today's stock price, that gives you a forward-looking dividend yield of 7.29%. The frequency of this dividend is quarterly, so the company pays you every single quarter. And again, this 2007 and 2008 drop-off in the dividend, those were from the spinouts. And actually, the Altria Group is considered a dividend king, meaning that they have over 50 plus years of consecutive annual dividend increases. The 5-year compound annual growth rate of the dividend is 4.27%. That is not the highest growth, but it is a reliable grower. Their latest dividend increase was 3.92%. And right here, we're going to focus on the sustainability of the dividend. And to do so, we're going to take a look at the payout ratios. And I have two that we can look at here. That's net income and free cash flow. Now, most of the time, the default payout ratio you'll see is net income, which is based on GAAP accounting or GAAP earnings per share. So this is showing what percentage of net income is being paid out in the forms of dividends. As of fiscal 2024, that was 60.7%. So that's very sustainable for a mature company like the Altria Group, where their goal is to return a lot of capital to shareholders via dividends. However, if we go and look at the history, you can see for 4 years here, the dividend appeared to be unsustainable based on the net income payout ratio. But that wasn't because they weren't generating enough cash to pay the dividend. This is where we get into the niche thing around GAAP accounting. They were taking write-downs on a bad investment they made. In this case, it was the company Juul, and they had to write down over $10 billion of losses. But they continued to pay and grow the dividend that time because they were still generating cash. And that's why I think it's important to look at alternative payout ratio metrics, like the free cash flow one as an example. And sometimes you even want to look at things like funds from operations, or if it's a pipeline limited partnership, something like distributable cash flow or adjusted EBITDA. If we're looking at the free cash flow payout ratio here, you can see that it was around 70 to 80% in those years. So the dividend was sustainable at this time. despite the net income payout ratio showing a 260% payout ratio. So those are some simple heuristics you want to look at to know whether or not this is a potential stock you could consider. Of course, you'll want to do additional research as well. And I'll give a couple more examples and point out some potential red flags as well. By the way, if you want to use the stock research platform showing throughout, it's all available at dividenddata.com. This is where you can access this stock screener. And right now is actually a fantastic time to join because we just started our Black Friday sale. And you can lock in 50% off annual memberships because we like to reward our long-term thinkers. After all, investing is a long-term game. So if you want to try out the tool and follow along with what I use, the link is in the description and pinned comment to get that Black Friday sale. There's a 30-day money-back guarantee, so no risk in trying it out. So let's look at a few other examples. We have Energy Transfer LP, that's ticker symbol ET. We'll search up ET and dive into it a little more. Now this one gets a little more interesting. As you can see, the company has a forward-looking dividend of $1.33, dividend yield 7.82%. And if you scroll down, you can see the stock price has been highly erratic throughout history. There was a period of massive overvaluation in 2014 and 2015, and this stock got dirt cheap during 2020 in the energy sector crash. If you don't know Energy Transfer, it's a midstream oil and gas stock. They own and operate 11,600 miles of natural gas transportation pipeline. If we take a look at the dividend data for ET, you can see the past 5 years, the dividend has grown a ton at a 16.8% CAGR. But this is where we get into a little bit of a red flag with this stock. They cut the dividend payment in 2020 when the oil prices were low. And high yield dividend investors that want to focus on reliability of income, this could be a red flag. We could potentially be in one of those environments again, and you could see your income slashed in half. There was a 50% decline at that time. So with this stock, when you're looking at the 5-year CAGR and 3-year CAGR, it's a little misleading. Because actually, if you look at the 10-year compound annual growth rate for ET stock, it's actually only 1.5%. They've only just started to get above that old pre-cut dividend. Now, the nice thing they have going with them is over the past year, they've grown the dividend over 3%, and they've restarted a pattern of increases every single quarter. Is the dividend sustainable right now? On the surface level, I'd say yes. We're at a 96% payout ratio based on net income. But again, this can be kind of misleading at times. You gotta dive deeper into it. Based on free cash flow, the payout ratio is 62% in fiscal 2024. And they actually grew the dividend a lot in years where based on free cash flow, it was unsustainable. But with these midstream oil and gas partnerships, there's a lot of factors you actually have to look into. For one, this company has used a lot of debt to fund its growth. As you can see here, if we look at net debt, that's $60.3 billion. Ideally, you want a great balance sheet with low debt and even possibly negative net debt. But that's very hard to find with capital-intensive infrastructure-based businesses like Energy Transfer. And what a lot of these midstream partnerships like to report is the ratio of debt to EBITDA. So let's do some more research around Energy Transfer and its sustainability. So here I'm typing in ET stock, EBITDA, operating cash flow, free cash flow, and dividends paid. And it's gathering these metrics for us. And the reason why I'm doing this here is to give you more of an insight around dividend sustainability. So we know the company pays $4.62 billion a year in dividends as of fiscal 2024. The company over the trailing 12 months has generated $10.8 billion in cash from operations. And the free cash flow sits at $5.1 billion. Free cash flow is one of the best metrics for dividend stocks because it represents all the cash left over after capital expenditures or things like servicing the debt. And this cash can be used to pay out distributions or dividends, buy back stock, and really just any productive thing to invest in the company. So given they paid $4.2 billion of dividends, it is sustainable based on free cash flow. And if we look at a metric like EBITDA, which is the preferred option in a lot of these midstream oil and gas stocks, over the trailing 12 months, they have $14.8 billion of EBITDA. So ET definitely generates a lot of cash. Now, some additional information you need to know with this example is that it's a master limited partnership, and your alarm bell should go off anytime you see LP in a stock name. And the reason why this is important is that these are actually not considered dividends or qualified dividends, which are tax advantaged. The example of the Altria Group, which I gave first, that's a tax advantaged dividend. That can be a qualified dividend if you're a U.S. investor. If you invest in a stock like ET, you would be getting a K-1 tax form, which is another thing that you need to fill out for your taxes. This is in addition to the normal 1099 div form. I've done these K-1s a few times. It's not that much of a problem, but some people tend to avoid these kinds of stocks because they add complexity to taxes. And I'm pretty sure some tax professionals will even charge you more if you have a lot of K-1s. But other than the forms and everything, the main point you need to know with these is that they're taxed at ordinary income rate. And this is the same as real estate investment trusts, REITs. so it's not completely novel. And one thing that you'll notice while screening for these kinds of stocks, that's that many of them tend to be in the same industry. And some of the highest quality ones that I found are these midstream oil and gas stocks. Many of them are partnerships. So I'm going to give you a couple more examples of midstream oil and gas stocks that I personally own, and I actually think they're better. One of them requires a K1, and interestingly, the other one does not. And they both come up when we're doing this screener. If we look up the company, you can see forward-looking annual dividend payments, $4.31, 8.09% dividend yield. 2014, 2015, they were overvalued. Same's here with MPLX. Now, the first thing I'll point out here with the non-GAAP earnings per share is that it's growing at a more reliable rate and faster than ET. You can see it's a quarterly payer with very high growth. The 10-year compound annual growth rate is 8.64%, and they just had another 12.5% increase. The prior increase was 12.5%, and the one before that was just under 10%. This high growth is insane for a company with a dividend yield of 8.09%. If we look at MPLX, it has a 73% free cash flow payout ratio, 83% based on net income earnings per share. And this is the stock that's also a master limited partnership, so you would be getting a K1. And for the final example I'm going to share here, it does show up on the list, but we got to go a little deeper. It's down on page 2 here, and that's Hess Midstream LP, HESM. Now, this one's interesting because it is a partnership, and it does have the LP, which signals that to you. But they actually changed corporate structure a few years ago. So I'm asking a simple question like, is HESM a K1 or a 1099 div? HESM is one of the rare examples of these midstream oil and gas partnerships that you get a 1099 div, not a K1. And this is why it's nice to have the AI tool built into Dividend Data, because yes, you can look at the metrics, but sometimes there's questions that you just need extra context around, and you can do it all in one platform. So let's take a deeper dive into HESM. Forward-looking annual dividends, $3.02. Current dividend yield, 9.06%. That's very high. And this company has had a lot of weird changes. I've done a deep dive into it, but I'm zooming in here to get you a closer look at the growth of the earnings per share. That other data was from before they were a public company, and it was kind of weird. Their structure's odd. But as you can see, there's reliable non-GAAP earnings per share growth. If we dive into the dividend data, you can see it's a quarterly dividend. And what's interesting is that they have been growing it every single quarter. And I should have mentioned this with MPLX. Both HESM and MPLX did not have that dividend cut in 2020. They continued growing it throughout that period. And when I've done more research in these companies, there's actually key differences in their business models that allowed them to do this. They also have less leverage relative to ET. But in the big picture, if we take a look at HESM, 5-year dividend CAGR is 11.31%. Over the past year, it's grown at a 10.25% CAGR. The most recent dividend increase was 2.42% that just happened. The one prior was 3.83%. And again, this is another one where net income payout ratio doesn't really tell the whole story. It's been over 100% the entire time when they have doubled and tripled the dividend. Now, based on free cash flow, the current payout ratio is 37% based on fiscal 2024. And to just give the same look as we did with ET, we're going to look up the operating cash flow, free cash flow, EBITDA, and dividends paid. So just to give some context, the past quarter, $82.9 million of dividends paid. It's quarterly, so we project that forward. That's $331 million on a forward-looking basis. EBITDA over the trailing 12 months for HESM is $1.2 billion, and you can see reliable growth there. Cash from operations is $996 million, reliable growth. Free cash flow, $712 million over the trailing 12 months. So there's plenty of room for that dividend payment to continue to grow. It's sustainable. There's no risk of a dividend cut. HESM is a really interesting business. They have a fixed fee-based model with inflation escalators. They have minimum volume commitments, which give them very stable cash flow and a floor. That's part of the reason why you don't see a dividend cut, even during years like 2020. But this is not a full HESM stock review video. It's about finding high-quality, high-yield dividend stocks. And I hope you got a lot of value about my process and how I think through these kinds of investments. If you did, make sure to leave a like, comment, and subscribe to the channel. It helps us out a lot. And if you want to use the stock research tool I showed throughout, it's all available at dividenddata.com. We have our Black Friday sale going on right now where you can lock in 50% off annual membership. The link is in the description and pinned comment of the video. And I want to put a disclaimer here that this is not personal financial advice. You should always do your own research before making any investing decisions. And I'm just sharing my opinions and my thought process, and also great tools so you can do your own research. With that said, thanks for watching, and I'll see you in the next video.